Good day, everyone, and welcome back to First Bank Wealth Management's Market Commentary video series. I'm Todd, Executive Vice President and Managing Director of First Bank's Wealth Management Group. Well, unfortunately for investors, the trade fight between China and the U.S. is getting worse. I first addressed trade last November and mentioned that a trade war was my biggest concern regarding what could negatively impact our stock market. I warned that conventional wisdom believed that a trade war with China would be avoided. But as you've heard me say many times, conventional wisdom is often wrong. Moreover, we have an unconventional president, so investors should expect unconventional tactics. The markets are yet again under pressure because of the latest back and forth with trade. At the heart of investors' worries is that the U.S. trade fight could push the U.S. and the world's major economies into a recession. Signs are everywhere that growth is slowing, including in economies of India, China, Singapore, New Zealand, and most of Europe. Here's the latest on the subject. We had the G7 summit in Japan at the end of June. President Trump and China's Xi Jinping made nice and promised to restart trade negotiations. Things were looking promising. Corporate earnings for the second quarter were coming in slightly better than expected. The Fed cut interest rates 25 basis points, and U.S. GDP grew at 2.1%. Then, almost out of nowhere, President Trump ordered an additional tariff of 10% on another $300 billion in Chinese imports to take effect September 1st. These new tariffs do not include the $250 billion already tariffed at 25%. Of course, China has to go tit for tat, so they responded by weakening their currency, the yuan, and halting U.S. agriculture imports. The U.S. called China a big currency manipulator, and this entire back and forth has caused our stock market to lose hundreds of points. As I was walking in to record this video, it was just announced that the U.S. will now delay the 10% tariff on some items, including cell phones and computers, until December 15th. The trade situation is extremely fluid. The U.S. stock market is down 5% from all-time highs reached just last month. So what should investors do? I don't see the trade fight being resolved anytime soon, which means to expect continued stock market volatility. We are telling clients to get comfortable with being uncomfortable with stock market swings. If you are a long-term investor and are taking a long-term approach, hang in there with us. You must remember that volatility is the price we pay emotionally to make money over the long term. Not to mention pullbacks and corrections, they're normal. There have been 25 corrections of more than 5% since March of 2009. That's an average of 2.5 each year, and each correction looked very scary at the time. Use any major sell-off as an opportunity to add to your positions. Think of it as buying something great on sale. We don't see a recession occurring in the U.S. anytime soon. The U.S. economy is fine. We believe once we resolve the trade dispute, which could take a while, the markets can go higher. Until then, stay broadly diversified, keep an allocation to short duration bonds, and use any equity declines as an opportunity to rebalance your portfolio. And of course, stay close to your First Bank Wealth Management advisor. Thanks for watching. See you next time.